Welcome back to the Deep Dive. Today we're digging into a moment that really redefined the entire market narrative.
A huge moment.
A huge moment, yeah.
Yeah.
I'm talking about that dramatic, that V-shaped recovery that came right after the mid-November panic. We are ripping straight into the holiday-shortened week of November 24th to the 28th, 2025.
And our source material calls it the gratitude rally.
The gratitude rally, I love that.
Yeah, and this is a deep dive driven really entirely by proprietary analysis. We're working directly from the LoopMarket reports authored by Devin McClarty.
Right, these are the documents from D Investment Enterprise LLC, published by D Publishing Group.
Exactly. And they give us this unique structural view of how capital is flowing. It's not just about price.
So our mission today is to figure out how the market erased all those losses so quickly. And more importantly, why this wasn't just a relief bounce, but maybe a signal of what the sources are calling a Goldilocks return.
And that proprietary lens is just so key here. When we talk about these reports, we're not just looking at charts. We're using methodologies they call structural intelligence.
Okay, break that down for us. What is structural intelligence?
So for you listening, think of it as a system that analyzes the underlying, like the architecture of how money is being allocated.
So not just where it ends up, but how it's being deployed.
Precisely. And that's what allows the sources to say right up front that the week can be summed up with just three things: risk returned, liquidity returned, momentum returned.
Wow. That quote is the ultimate hook, isn't it? It really confirms that whole narrative battle we were seeing. Fear was winning earlier in November.
It absolutely was.
But that quote just signals conviction taking over. Decisively.
Exactly. This V-shaped bounce wasn't some random thing. The sources paint it as a deliberate, a decisive effort by institutional money to repair the damage, to get a foundation set before the year ended.
Okay, so let's unpack this rally. Let's start with the hard evidence. The numbers. This reversal really did surprise a lot of people. For that week of November 24th, the S&P 500 closed around 6,849. That's a plus 3.7% gain.
And 3.7% that's a massive move for a week that was shortened by a holiday.
Right.
It tells you the market was basically sprinting to get back to where it was before all those mid-month jitters. But the real story, the real conviction that was in the Nasdaq Q, it closed near 23,400. That's a blistering plus 4.9% for the week. Just total outperformance.
And that outperformance in the Nasdaq Q, being the hub of growth and tech, that's always a clear signal. But for that signal to matter, the interest rate environment has to cooperate. So what was the role of the 10-year Treasury yield that week? It feels critical.
It was the silent hero. Absolutely. It just stayed stable, hugging that 4.01% line.
The foundation.
Exactly, the foundation. That stability provided crucial support, especially for those high-duration growth stocks in the Nasdaq Q. If we'd seen that yield pop to, say, 4.2% or higher,
it would have been a different story.
A completely different story. The whole tech valuation model would have come under immediate severe pressure. That stability at 4.01% basically just took the rate hike threat off the table for the moment.
So, okay, the market had a mission. Erase the panic, restore momentum. The numbers show it was accomplished. But the big question is, was this just, a seasonal holiday bounce, or was it something deeper? Structurally driven?
The McClarty reports argue it was definitely the latter, structurally driven. The market came into the week with clear intent, and that intent was fueled by three confluent, high-impact catalysts.
Let's get into those drivers then. The first one is always the elephant in the room, the Federal Reserve. What specific communication shifted the dial from fear to, optimism?
We saw what the sources call a decisive soft pivot signal. Now, this wasn't a formal rate change or anything. It was verbal, a commitment to a specific path.
A kind of forward guidance.
Exactly. And it effectively removed the tail risk of, aggressive tightening in the near term. By giving that clarity, the Fed essentially de-risked the near-term policy outlook.
Okay, but hold on. How decisive can communication really be, especially right before a holiday? I mean, fear returns so fast just 2 weeks before this. Isn't calling it a decisive soft pivot based only on words a little optimistic? Where's the hard evidence?
That's a fair challenge, a very fair challenge. And that's where the second catalyst becomes so important, because it's the validation. The hard evidence came from consumer spending.
Okay.
Specifically, the early holiday shopping data, the Black Friday results. This wasn't just investor hope, this was actual consumer action.
So you're saying the strong sales numbers basically validated the Fed's confidence?
Precisely. The spending data confirmed that long-standing idea that the consumer engine is still robust. And when you prove consumer resilience, you provide tangible support for corporate earnings expectations, especially for the all-important final quarter. The Fed gave permission, the consumer provided the performance.
And when policy anxiety drops and the consumer holds up, I mean, the path is clear. What happens to all that capital that's been sitting on the sidelines?
You get the third catalyst.
Uh-huh.
A critical, massive return of liquidity. Just think of all those investors sitting on cash for 2 weeks, super nervous.
Right, total risk aversion.
The moment the Fed gave clarity and the consumer gave validation, it was like the floodgates just opened. That influx of capital provided the pure kinetic fuel for that sharp advance. The conviction was instant.
Okay, so the capital came rushing back in. Now, let's follow the money. This aggressive risk-on rotation, it tells us what investors really believed about the future.
And the rotation was a textbook display of confidence returning. Investors just completely abandoned that defensive posture they'd been in.
No more hiding.
No more hiding in low-volatility sectors. They rushed straight into growth and cyclicals.
And the leadership was pretty unambiguous from what I remember, who really took control of this rally.
Market leadership was just dominated by technology, so XLK and consumer discretionary XLY.
The perfect pairing.
It's the perfect pairing to confirm that Goldilocks narrative, right?
Yeah.
Stabilizing yields, that 4.01% 10-year make tech more appealing. And confirmed holiday spending directly boosts XLY. It's the market betting heavily on both future tech and immediate consumption.
We also saw that enthusiasm spread out a bit. Industrials and financials showed pretty broad strength too, so it wasn't just a big tech bounce.
No, absolutely not. But the laggards are just as insightful here because they show you the market's priorities. The energy sector, XLE, lagged a lot.
Which is pretty typical when growth is the story.
Very typical. When capital shifts that aggressively into a growth narrative, it often steps away from commodity-driven sectors like energy. It isn't necessarily a bearish signal on oil prices. It's just a comment on prioritization.
So investors decided that chasing the high multiples in tech and retail was a better short-term use of capital than, say, the slower return from energy.
That's it, exactly. It signals a move away from cyclical or value-based plays and a powerful shift towards secular growth. The focus becomes all about maximizing upside, and that reinforces the institutional conviction we were just talking about.
And that conviction, that belief the conditions were just right, it brings us to the central macro theme from the sources. The Goldilocks return. It sounds simple, but what does it really mean in this context?
The Goldilocks return is that sweet spot. The macro environment is just right. It's not too hot, so inflation isn't spiraling and forcing the Fed to tighten.
And not too cold.
And not too cold, so we're avoiding a deep recession. This perfect balancing act is what the market craves. It justifies high valuations without, risking a crash.
So let's break down the 3 pillars that the sources say created this ideal condition. This seems critical to understanding if the recovery had legs.
Right. The McClarty reports highlight 3 pillars working together. The first one is consumer strength. This wasn't just a guess. It was confirmed by retail stock performance, by the Black Friday sales figures.
And why does that consumer strength matter so much beyond just retail?
Because the consumer is, 70% the economic engine? When people are spending, companies can maintain pricing power, they can deliver on profit margins, and that's the ultimate driver of stock prices. This pillar established the not too cold side of the Goldilocks equation.
That makes the fundamental case. So what about the second pillar, the one that addresses the not too hot side of things?
That would be policy stability. The clearer Fed communication, that soft pivot, it solidified expectations for manageable policy going forward. Specifically, it signaled a strong likelihood of a rate cut in December.
And that's about more than just one rate decision, isn't it? It's about reducing volatility.
It is. Stable policy just reduces fear. It reduces uncertainty. And that's the single biggest barrier to large-scale asset purchases. When institutions can predict the future cost of capital, they can run their models confidently and they can deploy cash. A predictable Fed means investors can focus on company performance, not policy risk.
Fantastic. Okay, so that brings us to the third pillar, which is about the chart action itself, the technical repair. How did the rally actually, fix the market's mechanics?
Well, the intensity of the gratitude rally was powerful enough to repair the really severe negative patterns, the broken charts that had formed during the sell-off.
Right. When a chart breaks support, it attracts short sellers.
Exactly, and systematic sellers. The V-shaped recovery completely reversed that. It restored key moving averages and crucial support levels.
So the technical repair is important because it acts almost like a self-fulfilling prophecy. It brings in a whole new class of buyer.
Precisely. Positive chart momentum is a powerful magnet. It attracts technical buyers, algorithmic traders, momentum followers, all of whom needed to see that trend reversal confirmed. And that influx just reinforces the upward move and makes the rally much more self-sustaining.
So when you have all three, consumer strength, policy stability, and technical repair, when they all align,
You fundamentally establish a constructive foundation, a foundation for what could be a really powerful year-end rally.
what's so fascinating is that the Goldilocks return, as it's defined here, isn't just a coincidence. It's a structural condition built on balance, on confidence, and on confirming health.
Right. It forces you to see that the market chose to believe in that balance. It was an active choice.
Okay, to wrap this all up, our deep dive into these unique LoopMarket reports, we have to touch on the philosophical core that's provided by what they call the financial engine perspective. It really summarizes this whole shift from fear to conviction.
It does. The quote of the week in the report gives a really deep summary of different assets and market drivers. It goes, gold measures fear, the dinar measures faith, the dollar measures dependence.
Wow, okay, that's a loaded sentence. Let's unpack that a little for everyone listening.
Yeah.
How do those three assets map to the investor psyche we just saw shift?
Well, gold measuring fear is pretty intuitive. It's the classic flight to safety asset, the hedge against uncertainty. You buy gold when you're running away from risk.
Okay, that's clear.
Yeah.
And the dollar measuring dependence.
That really speaks to the current global financial system. The dollar measures reliance on central bank policy, on its reserve status. Investors rely on the dollar when they are dependent on a central bank, like the Fed, to keep things stable.
Which leaves us with the dinar, measuring faith. How does that connect to what happened in the market?
Historically, when sources like this reference an asset like the dinar, it usually speaks to a deep structural conviction, a long-term faith in a fundamental, maybe even hard asset-backed economic system. The market shift during the gratitude rally. It wasn't driven by buying gold, which is fear.
Right.
And it wasn't just a passive dependence on the dollar. It was driven by an active faith, a conviction that the economy was healthy enough to justify a massive risk-on move into growth. It's a measure of high conviction deployment.
That really does encapsulate the entire shift. And we have to be clear again that this whole analysis, including concepts like structural intelligence and the financial engine, it's all sourced directly from the LoopMarket reports, authored by Devin McClarty, owned by D Investment Enterprise LLC, and published by D Publishing Group.
Which is identified as a McClarty source and D Publishing Group copyright asset. Understanding that attribution is crucial when you're looking at a proprietary narrative like this one.
Absolutely. So we've seen this massive rally, a powerful move away from fear and toward confidence. If gold measures fear and the market is now in this Goldilocks state, here's the final thought for you to chew on. What specific metrics are you tracking now to measure the return of that faith versus the continued dependence on policy stability? Is this conviction self-sustaining, or does it need constant reassurance from the Fed as we head into December?
That's the structural question, isn't it? The narrative always shifts. And recognizing those layers, well, that's what separates a bounce from a real structural rally.
Keep analyzing those narratives, keep recognizing these powerful patterns, and we will catch you on the next Deep Dive.